Okay guys, welcome to the video. What we're going to do today is talk about Texas Pacific Land Trust. This is the next stock that I bought in this downturn right now, and I'm going to show you why I did that and what the reasoning behind the valuation is and just some of my reasons for buying in the stock. So let's go ahead and jump in here. We're going to look first of all at our worksheet. We're going to go through and do an evaluation worksheet just like we did before. So what you have on the screen is the worksheet. I had the one we did yesterday on here for Copart. So this one is actually going to be for TPL. That is the ticker symbol for Texas Pacific Land Trust. So what you want to do is, just like before, we want to go find earnings per share trailing 12 months. I don't know why that's so hard for me to say. If we go here to macrotrends.net, I already had it brought up, but you just go to revenue and profit, earnings per share, revenue, or earnings per share trailing 12 months is, what did that say? 41.09. So we put that in there. Now we need to get the analyst consensus growth rate. So we go to Yahoo and you can find it on analysis. You bring up the ticker, then you go to analysis. You can probably find it other places too, but you can definitely find it there. Next 5 years per annum, non-applicable. Do I have the right thing brought up? Oh, that's interesting. So you guys are going to get to see my me fumbling here for an answer. So let me find this. I'll be right back. Okay, so what we got to do here is we actually have to, because for whatever reason, Yahoo is not showing Yahoo Finance. It's not showing the analyst consensus growth rate. Now, I will work to find out why that is, but when either there's an analyst consensus growth rate that is too high or one that you don't think they can sustain, like if it says 30-40%, you don't think they can sustain that, you can enter your own. But I'll show you how to calculate one to kind of see what you're looking at if you don't have an analyst consensus growth rate. You can see that we have one here that says for next year it's 19%. So we could use that. That might be realistic. You know, we could go here and plug in 19% and we would get all of our numbers and we get a price. So what we can do though is we can actually take the book value per share from the last 10, I actually went 11 years because I had the data available. So you can go to macro trends, key financial ratios, scroll down to book value per share, and you'll get the current or most recent year on the left here, going all the way back. This one always goes all the way back to 05, so it goes quite a ways back. But I took 11 years, and what you want to do is set up a formula that will actually say, here's year one. What percentage of year two was year one? Did it go up or down, and by what percentage? So on this one, it actually went down 4%, so it's -4. But you carry this out, and you see in the last few years here, they grew tremendously, their book value per share. So what the company's, their actual assets are worth per share. That's another way to get a growth rate. And you can see I came up with 51%. That's obviously ultra aggressive. I don't know that we could, just because they did this the last 3 years, that's really cool, but I don't know that we could anticipate that they would be able to sustain that kind of growth. So I'm going to usually use 19, the one, from Yahoo, where it just says for the growth rate for the next year that the analysts are predicting. In this case, that is a lot more conservative than using what we calculated here on book value per share. So as you can see with this worksheet, I already had 15% return that we want to try to get. And I had a 50% margin of safety, meaning I want to buy it for half of what it's worth today, assuming a 15% growth rate and the future value. So what it gives me is a buy price of 807 because the full price is 1615.73 to be exact. And if we go look, this thing is selling for 352. So it's selling for less than 25 cents on the dollar right now, close to 20 cents on the dollar. And some things that attracted me to this company is we can go over to their website and see what they actually do. This is going to kind of give a history. TNP was created through a federal charter providing a mandate to build a transcontinental railroad from Texas to California. Texas, California, and present-day Arizona and New Mexico each agreed to grant sections of land for every mile of rail built. And you can go through here and you can see, when you click on this little timeline, you can see what happened. It didn't complete the full line, but it completed 972 miles, entitling it to 3.5 million acres of land in Texas. Back in 1888, oh, and I want to point out that too, 1871 was when this thing kicked off. 1888, the company back then went bankrupt, and this land was put into a trust. 1920, they started producing oil from it in the Permian Basin, and it was actually the first oil pipeline built in the basin on this land, it says, and the first well to produce oil from the Permian, which is kind of cool. The certificates of the Texas Pacific Land Trust were listed in 1927 on the New York Stock Exchange, and the sub-share certificates remain actively traded today. So you can go through the history of this thing. You can see, kind of what they've done in the past. I would encourage you to go look at this. They've been bought and sold. But the thing is, they actually have almost 1 million acres of land in Texas, which they do oil. They own the oil rights for oil production and water. So it's not just oil. But when we go look at my reasons for owning this stock, I'm going to get this out of the way here. One of them is longevity. The other one is the growth that they've had. And you can go look at, earnings per share growth too. This right here are their income actually. This is their earnings. But if we look at earnings per share, you can see the growth trend. You can see more often than not, they're growing every quarter, their earnings per share. And especially in the last 3-4 years, this thing has been on a good run. And I just think this company, I would encourage you again, go look at this for yourself. But I think this thing is pretty big discount right now. If we look at what they were trading pre-drop, let me go back to the Yahoo chart here. Let's just look at a year, and we go back $900, 600, 900, 800. They did a little bit of a dip there at the end of 19. A lot of companies did that. They haven't been this on sale as they are right now since basically 2017. We're seeing 2016, 2017 prices, and then they've went up past the $800-900 mark, and they were floating right in there for the last year. And we can even see year to date, $800, $700, $790, $800, and then of course March 2020 things change. So I think this represents a stock that is quite undervalued and is selling at quite a discount right now. Even if I'm wrong about the price, I'm actually buying. We could look at it this way. Let's say I want a 75% margin of safety. It's 352. Kind of work this backwards. 80%. It's selling at what, a 78-ish% margin of safety right now. That's pretty dang good. That means I could be way wrong, and there's so much upside on this that it's hard to lose. And it's not a gamble. It's a company I want to own. I think it's really cool. It's backed by real estate. You can see in my reasons for owning their assets. Well, their assets are real estate. They're not making any more of it. That's also their competitive advantage. You're not going to get the opportunity to build a railroad and get millions of acres of land out of the deal. That's just not going to happen. You're not getting more railroad track today, and you're not getting more dirt. They're not making any more. They're not putting any more in general. So I think it's really cool. They're well positioned, and they're pretty well ran. If you look at a lot of the numbers, that tell you about the management, the return on equity, the return on invested capital. Those are up there. They're growing, growing, growing. If we go look at their debt, I think I have that up here. Let's see. So here's their net income. Last trailing 12 months is about 300 million, 0.319 billion. So let's go look at their long-term debt. Just go to assets and liabilities, long-term debt, 0.003. Look at that. That is so low, it's ridiculous. They have basically no debt. I mean, pennies of debt. They could pay this off in 3 days of earnings. So this company, again, is well positioned to weather the storm. Their revenues could drop in terms of permits for leases, for oil leases and that sort of thing when oil's down right now, but their assets don't depreciate typically. They appreciate. Land goes up, and land has extremely low overhead, right here. This is not airplanes, or mining equipment or something that is a ton of operating expenditure, and capital infrastructure and all these things. This is just, it's land. And so I think it's on sale. I think it's pretty massively on sale, to be honest with you. It's something I'm happy to own, and I'm going to jump into my account just real quick and show you. I only have 5 shares in here. Let me see if my cost basis will show up here. And let's do unrealized. So TPL, I'm at a adjusted cost per share of $300. That's pretty good. It's already up $52 a share. And then over here in the 401k, TPL, let's go to orders, and let's do the last 30 days. And we'll sort by the ID, if I can get it to sort. So here we go. I bought, does this say how many shares? 10 and 11. So that's 21 and 5, so 26 shares, not a ton of it, but and it doesn't have the price does it have the price I bought it for? Okay, yeah, $4.39. See, I paid way up there for these shares, but these shares I paid $3.50 for, so my adjusted basis is around $3.80, $3.90. So I'm down right now in the 401k. I'm up in here. I think it's going to return to pre-March 2020 levels here pretty soon, and maybe not. It might take a year, it might take 2 years, but it's if it goes back there, I'm gonna over double what my initial investment was. So I don't care if it takes a few years. That's going to be a pretty nice rate of return. So that's what I have for you today. TPL, Texas Pacific Land Trust. Go check them out. Go see what you think about their business model and what they do. Research the management. Be comfortable with it yourself. This is not financial advice. This is my disclaimer. I'm not a professional, but I think they're a really cool company, and I think they're on sale, and I think it's something you may want to pick up while the market is down and while they're going at a discount. So remember, it's not a good deal if it's not a good company. Do your research, do your homework, and make some good choices and make some money. Catch you guys later.